stick around for the whole time. This is going to be recorded. We'll send this out to you. It takes us a little while to convert this and compress it, then send it out in the emails. But for those of you that are actually able to watch this, hey Trevor, throughout this webinar, watch it again even when you get that in the email, because it will help all these nuances sink in, especially if you're new to trading or if you're even new to this particular strategy. So I highly recommend doing that. It will make it sink in, and you'll catch some of the things you may have missed when you were thinking of questions and things of that nature. Let me get a couple of things out of the way before we get started here. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I actually started out trading in college with a psychology degree, some money I had earned throughout high school and stuff like that, working on farms and all those fun things, detasseling. And I started investing in stocks and then kind of started selling calls against it throughout that time. And when I switched over to finance, got my finance degree, graduated from college, decided to move up to Chicago with basically no job, and started walking around the floor of the Board of Trade, got hired on as a runner, and then sold out all my stocks, bought my badge, and started trading in the pits. So I basically traded every market for the most part. It seems like everything from stocks, financial futures, commodities, currencies, and options on all of these products, and basically all market conditions. About the only market condition I missed was the '88 crash, but other than that, I was trading through everything. And I actually did miss the flash crash that everybody always talks about. I was trading during it. I left in a bunch of orders. Wife was bugging me to go to Home Depot to get stuff for the yard. Left for about 30, 45 minutes, came back and was like, how did I get all these trades? But anyway, I got to go over this disclaimer. It basically says any opinions, news, research, and analysis or other information contained here does not constitute investment advice. And the reason why is because we don't know your risk parameters. We don't know what's in your portfolio. And therefore, I just can't tell you what I think is right for you. And, you know, the powers that be say that I can't do that too. And that's the correct stance, you guys, is with me not knowing what your risk parameters are, what's in your portfolio. It is not fiduciary responsibility to go out there and tell people that kind of stuff. And please remember, the past performance in any trading system or methodology is not necessarily indicative of future results. Why am I, are you guys asking about this? Why am I crying? I actually have a picture of it up on my wall from the thing. It was from a jobs report. Unenjoyment Friday is what we used to call it. And I wasn't crying. I was just sweating bullets. You know, you were basically elbow to elbow with people in the pits, and that was like a minute to like take a breather. So I wasn't crying. I was just sweating like crazy from screaming. Probably lost my voice even. I've used it a few times. Your risk reversal strategy works great. Trade is very easy from the psychological point of view. Thank you, Andreas. And as a matter of fact, this is going to be an extension on that risk reversal today with this double bull spread, or the double is what we call it on the floor. And in the Fed funds pit, we used to call it the Toro Loco, or the El Toro Loco, which is the crazy bull spread, because we were in Fed funds and it had to do with somebody came in and did a risk reversal, or actually this double spread. It meant they were really sure rates were going to be moving, because Fed funds don't move really fast. So if you're putting on an option spread with a double bull spread, you've got a pretty good idea, or at least inclination, that the rates are going to be moving in a particular direction. Oh, in the photo, this photo right here, right? I'm not crying in this one. Well, I'm kind of crying in this one because it meant the end of pit trading. But this one was unemployment Friday on the jobs report. It was a massive surprise, and Fed funds went crazy. As a matter of fact, the rest of the floor was pretty quiet, and Fed funds were going nuts. All right, so let me go on. So you can also follow me on Twitter at Wolfman's blog for market commentary, snark, stuff like that, and good wisdom actually coming from at ProTrader Strat, which is the parent company of what we're doing here. So like I said, this is the double bull spread. One thing I mentioned on the floor, we also called it the El Toro Loco, the crazy bull, because it's really a bullish spread. And so is the risk reversal. It's the same idea in a sense, but this was the one that we had called, instead of saying the double or, you know, bull spread, some people call it, or double bull spread. We just, you know, everybody always likes to make up their own names and stuff like that. And that was one of the things that we kind of called it in the Fed funds pit. What is that? Floor is very crowdy. I don't know what you mean by that, Andreas. Anyway, market assumption is bullish. Thus the Toro Loco, the crazy bull. We want this market to move up, and because it's not really like the risk reversal, because we're kind of capping our possible profit and possible loss in this one, it also causes us the need to get a little bit closer to the market. So we don't have as much wiggle room to the downside as we do in the risk reversal. That's the beauty in doing some naked options a lot of times, is that it allows you to get further away from the market and still do the same thing. This one we are having to tighten up the market just a little bit, so we want to get a little closer. Oh, yes, the floor is very crowded for sure. You are, I can't really say it on here, but there's a phrase that says something like we were something and elbows being that tight, and literally you would be shoulder to shoulder, and if anybody moved, the whole pit would go. As a matter of fact, when I first started working down there, they didn't have metal railings and they were wood railings, and it was a really busy day, and in the 30-year options, literally they were like 2x4s as the railings to hold these people up. And there was, if you ever walked on the floor, those pits, like the pit that I was in, on one side it was like 3 feet drop. On the back side it was at least a 25-foot drop to the floor. And the 30-day or the 30-year bond options one year got really busy, and basically when people are trying to jockey for position, the whole momentum starts shifting, and the people on the corner got smashed, and the 2x4 broke, and it was just like, a dam broke, and people were just like flying out of it. It was pretty crazy. But anyway, yeah, so it's crowded and there's no place to move. All right, so how do we build this thing out? Building the bullish risk reversal. Very similar. We're going to be buying an out-of-the-money call spread. Before, remember, we bought the call. Now we're doing the call spread. And we're going to be selling an out-of-the-money put spread. So similar, we're going to have to, like I said, get a little bit tighter on this. And we're still going to be looking to build this for zero outlay of cash or small credit. So, and remember that like Vega and Theta are going to be very equal, so they're going to offset one another. You also don't have to really worry as much about earnings, because as the calls lose value in earnings because the stock price loses value, those put prices will gain in value for that same. So they're going to offset a little bit there. All right, so our keys to success. What's the difference between this and the Iron Condor? Good question. Iron Condor, you're selling both spreads. With this one, you are going to be buying a call spread and selling a put spread. So in the Iron Condor, you'll be selling the call spread and the put spread. Trevor asked, do I miss the floor? Yes, absolutely. floor was the best job ever. It was a blast. Condor is neutral, absolutely. And this is not neutral. Good point, JC. Yes, this is very bullish. Even more bullish than the risk reversal, you guys. Risk reversal, you know, you're a little bit more neutral. This one, because we got to get a little bit tighter the market, we want to be a little bit more bullish on this one. All right, so the right underlying, this goes back, if you guys, I know we got a lot of return people here, but you know, we also have several new people in here. So what I usually say with picking the right underlying, you guys, goes back to the options and how wide the bid ask is. So any stock that's basically under $100, we want a tight bid ask, and that means the calls and the puts that are just slightly out of the money, we want those bid ask to be inside of 10 cents wide. Anything over $100 stock, rule of thumb is move it 3 ticks to the left, and that's how wide they should be. So something like Amazon, that was once $1,000 stock. Before today, it's a $900 stock. No, it did come back. I'm kind of making a joke there. You know, you move it 3 ticks to the left, and it would be about $1 wide. Now, after you get these massive moves in stocks like that, we saw those bid ask and Amazon go to $3, $4 wide after that first happened. But then they snapped right back, and they were pretty close to, you know, they came inside of $2 for a while there, but people were still, you know, a little bit tentative on making those tighter markets. Same thing happened in Apple. Apple usually has, you know, just a couple pennies wide. They went out to like almost a dime or more, but then they snap back as people try to pile in there. That's where the participation is. So there's people falling over each other to make better markets, and really what high open interest type of underlyings, and they'll make those markets up just in order to have that opportunity. Whereas you can see some stuff that are even in the Dow Jones 30, you know, I mean, you can find stocks in there where you go in and look at their options, and even though they're a Dow stock, there's just no participation in the options, and it could be like a $50 stock and they're 30 cents wide. I won't even touch those. Like Aon, everybody's heard of Aon. Aon has terrible markets in their options. So I stay away from things like that. So do I ever scan for options? I do every once in a while, especially when I'm having trouble finding a stock, you know, that I normally trade in my like stock of like, or my watch list of like 40 or something. I'll go in there every once in a while. And actually Steve Primo's got a really good scanner, especially if you like technical analysis for different rules that he has. So I've been playing around with that lately too. Off the subject, what's your next segment on earnings plays? You know, I'm going to be looking at doing like earnings setups. So that's going to be coming down the pipe pretty soon, because this is usually when we're in that lull. It's a great time to take advantage of earnings setups because you get that volatility expansion. So that's what we're going to be looking to do there pretty soon. So keep your eyes peeled for that. High open interest equals tight spreads. Yes, or high volume tight spreads, both. So whenever you get, and I'll show you when I pull up the platform, but usually speaking, when there's a lot of open interest in the options, it means there's a lot of people that are very concerned about that position, right? So they'll make tighter spreads. All right, so picking the right strikes. Now with this one, we're going to be trying to set this up, like I said, to kind of create it as a credit or at least no outlay of cash. Now, usually because we're doing spreads, it's going to be closer to, like we were talking earlier about the, we were talking about the risk reversal and the ability to kind of get away from the market, get a nice credit for it. With this one, we got to get a little bit tighter because it's defined risk. And that's usually the case, even with like an iron condor versus a strangle. You got to get a little bit tighter to the market. And that's the same thing with this, is we're going to get a little tighter. So we're going to start out with around the high 30-ish delta for the call. And I like it to land in the 30s, because that means that when I'm defining that risk, I'm buying a call at around 38, 39-ish. I'm able to sell a call at around a 16 delta to define that risk, and then flip over to the other side and look for the puts to be able to finance that. But again, then that means if we're doing a 38 delta in the calls, we're probably going to have to do somewhere around a 40 delta in the put, which puts you relatively close to where the underlying is trading. And you can play around with it, getting a little further away from that. But I like it this way because it's a high probability of success strategy when we set it up this way. Because remember, delta tells us the probability of the underlying being 1 penny in the money at expiration. So if it's a 39 delta, that means there's a 39% probability that it will be in the money by 1 penny at expiration. And if we're selling a 16 delta, same thing, 16% chance. But I'm not looking to hold anything into expiration. So I look at it as the probabilities of being tested. So with that being said, probabilities of being tested are 2 times the delta. And it's a ballpark figure. That's a floor trader hack that we would throw around, because it's actually really pretty accurate. It might even be stronger than that. But at the end of the day, we look at it as 2 times the delta is the probability of that strike being tested or touched. So that means I have better than a 30% chance of my short call being touched. Now, the similar situation on the put side is going to be the same as well. You're going to have that probability of being touched and tested. But that's why I want to set this up a little bit closer, because I don't really want it to expire for 0 or for what I paid for at 0. I want to make a little money, so I'm getting a little bit tighter. Now, if you like, you can likely build this out relatively the same way and get out into like the 20 deltas for the long call and the short call, probably a 10 delta then on the short call. But I like it to run in there because I want to make the money on the spread there. Screen is stuck on double bull. Are you seeing pick the right strike here, OM? Anybody else? All deltas crashed today. Well, yeah, deltas went crazy. Buying 40 delta put or something, or selling. You are going to be selling the 40 delta put and then buying right around that, probably 18 delta put. So we're buying the call spread, selling the put spread. Screen showing 11. Yeah, that's where we are. I probably talked a little bit too long on this screen. Did you get a, all right, we switched over to picking the right duration. Now that was picking the right strikes with the deltas. I was doing delta talk on the strikes. Now we're talking about picking the right duration. Now, you want to give yourself as much time as you can to be right. We're right in between earnings right now. You are going to have some, you're going to have dividends coming into play, but remember, because we are offsetting our calls and puts, it's going to be helpful that way. So with the picking the right duration, go out further in time. The reason why you're going to get better pricing. If you're doing it on a 45 days to expiration, for one, you only have 45 days to be right. Further duration, you're going to be able to get more time to be right. And I'm not planning on keeping it for that 100 days. I'm just planning on doing it so that I can get a credit. And when you get further out in time, you have a better opportunity to get a credit. And remember, like, theta is going to be offset and somewhat your deltas for the most part. All right, the right environment for this one, with the double bolt spread, I like the middle of the road IV percent. Now you guys know when I'm trying to sell stuff for a credit, I'm looking for high IV. When I'm trying to buy spreads, things of that nature, I'm looking for really low IV. Now with this one, it actually works out a little bit better when it's middle of the road. I don't like to do it when there's really high IV, only because that's when I want to take advantage of selling the premium and just collecting credits for that. With this, it's kind of because they're offsetting each other. I like to go with this at about the middle of the road, but it's not to say you can't do it when there's really low IV also, because the Vega is going to be offset. So if volatility expands, it'll be offset by the short spread, and when IV expands, the call spread's going to gain in value, and so will the negative or the short spread. So they'll offset each other. Same thing if volatility goes down, they're going to have a relatively counterbalancing move on one another. It's maybe a couple of pennies off, but for the most part, it's going to be relatively the same. All right. All right, knowing our exit strategy before entering this trade. Now, you know, with the last one, with the risk reversal, synthetic longs and stuff like that, that to me is pretty hard to discern for a mass, because I don't know risk parameters. I don't know what you guys have comfort in risking. With this one though, because it's a defined risk strategy, I feel pretty comfortable in saying basically what we're looking for is either pick your, you know, it's going to be up to your risk parameters still, but at the end of the day, when that long call is breached, you know, because we're, when the long call is breached, that would be one point to get out, because remember, you know, it has just touched that long call, and that's if you are a little bit wider apart, you know, but definitely seriously consider getting out when that short call is breached, because remember, we got a long call spread. So when that short call is breached, I would be very seriously considering getting out of this. For one, you don't want the assignment risk, and the other thing is you probably reached about 50% of your max profit, which is what I'm looking to take out of this. Because remember, at the end of the day, our probabilities of that short call being in the money at expiration is about half of what it is for just being tested. So the market move up and hitting it is twice as great as the market going up, hitting it, and staying there. So that at that point in time, I'm going to be looking to exit when my short call is breached. Sometimes when it happens super fast right after implementing the strategy, you're not going to be able to get 50% of that max profit, but I'm still going to be very trigger happy at getting out when my short call is breached, no matter where I set this strategy up. And the other thing is, on the max loss kind of thing, or on the downside, if we're going into a loser, I'm going to be looking at taking this as a max loss, and probably if it goes down, start looking like a max loss on this. For me, I'm going to be looking to just hold that into the next earnings, because we're going to have enough time on this strategy that it's going to be able to take us through to the next earnings. And in that, if it becomes, I'm just going to let it ride, and at the end of the day, you're not risking any more by holding it into an earnings event or that binary event, because, you know, if you've already lost everything on the trade, you might as well let it ride out and see if something happens and let it pop. So that's what I'm usually looking for. So between 45 and 100 days in duration, I usually look at somewhere between 70 and 100 days, and I don't really have a problem going further out than that too. Is there a standard high, low IV, or is it in relation to particular stock IV? It is, I go by IV percent, and that's what I look at in particular, because every stock has a different IV, right? You know, your energy stocks usually have relatively low IV, and your tech stocks and stuff like that will have usually high IV for themselves. But this is, or for, in comparison to a staple or an electricity, the utility stock versus a tech stock, utilities usually will have lower IV versus, you know, if you're just comparing apples to apples being IV. But IV percent puts that where IV is trading now in a percentage terms of where it's traded in the past 52 weeks. So if it's above 50, meaning it's above where it's traded 50% of the time, then that's when I'm going to be looking to sell premium, because that's an opportunity of finding higher premiums for that duration. Low IV being at, you know, it's at the, you know, 6% level of where it's traded in the past. That means it's got really low IV. That would be where I'd be looking for IV to expand and go into buy it. How doing, Bando? Under what conditions, stock chart movement, technical analysis, would you use this strategy? Anytime I'm bullish, Trevor, anytime I'm bullish. And the end-all be-all for me is not necessarily technical analysis. I know a lot of people trade by that. I used to trade by that more than I do now. Now I just look for opportunities. And I mean, technical analysis has to sink into my head because I've been doing it for so long. But I don't usually draw the support resistant lines. I usually kind of look at the chart and kind of can see where support and resistance is. So I don't really have something that I necessarily use for this. It's usually kind of a culmination of everything, you know, big moves down, 10% corrections, like especially in a day that we saw a lot of these tech things. I have to be thinking I've got to be looking to go long tech or go long staples, because staples have been getting beat up. You know, you look at like your Procter & Gamble, Kraft, Coca-Cola, none of those guys have participated in this rally. So if money is moving out of tech, it's probably going to move into these consumer staples, and then that might be the place to actually do better with this. So I've kind of looked at both of them, and basically a lot of them came down to some consumer staples that I kind of vetted for this, and that was during today's onslaught. It was just before Amazon and Apple and everybody fell out of bed. So I'm sure everything that I vetted for this is going to be out of whack now, so we'll have to see. What percentage off the highs or lows over how many days? I usually just, if it's like trending down like a 10% and it's relatively steep within, you know, maybe a week or two, that would be where I'd look for those 10% corrections. I just look for a 10% correction. It doesn't really have to be over a short or long period of time. If I can find a 10% correction, that's kind of a place where I like to step in. You know, the other thing is, if you start thinking, today there was 10% corrections in basically all of the tech stocks, but you know, if you think tech is kind of overdone a little bit and consumer staples are going to be the ones where it's kind of like a flight to quality in a sense. I'm not really concerned about the top because gold continued to kind of come off today, and usually that's the flight to safety trade, right? You pull your money out of stocks and you put it into gold. It seemed like people were starting to pull their money out of tech and rolling it into consumer staples a little bit today. So that's maybe the way I would kind of play it today. And that's what I was just kind of coming up with in my head today as we were going along. Let me get through a couple of these and we'll start looking into some stuff. Max profit on this, basically going to be the difference between the call strikes, all right, and plus or minus the credit or debit. So if the call strikes are $5 wide, your max profit is $5 plus the credit you received at the onset, or subtract it if you do this as a debit. I'm always going to try and do this as a credit. I like the credit. It puts your break even a little bit higher, and you know, anytime I can do anything for a credit, I'm going to try and get some cash. You have to make up, if you do it for a debit, you just have to make up that ground to do it. I'd rather have the credit to give me a buffer, in a sense, is the way I look at it. Max loss is going to be the difference between the put strikes minus the credit, because remember, the put strikes are going to be our loss. So if it's $5 wide, our loss is $5. But if we got a credit in the onset, then we subtract that from that $5 loss because we got to keep that credit. Or you have to add it if it's a debit. So $5 plus the 10 cents that you paid for it, it'd be, you know, $5.10 for that example. Does that make sense there? Oh, it looks like I got a double. All right, so let me skip over that. All right, so break evens then. When receiving a credit, our break even is going to be that short put strike minus the credit. And when we're paying a debit, it's going to be the long call strike plus the debit paid. So we have to get, you know, and that's at expiration, you guys. And keep in mind, all of that really is at expiration. There's a lot of things that go on during that time, but that's for expiration. And it's very difficult to give an exact break even before that expiration. But at the end of the day, that's your ballpark for it. If this market starts moving up right away, we're going to reach a break even relatively quickly. So that is only at expiration. All right, so this is the time where I usually kind of throw it out to you guys. Let's start looking at some stocks. Before this whole thing started, we looked at Amazon on the 1 minute chart. We were playing around before we started. And we could even look at Amazon, because if we look at Amazon on a daily chart, I'm pretty sure it had probably it had a 10% correction when it hit that low. It's probably a 5% correction closer to the end of the day. Let me put this on a daily chart again. So Clean Harbors, Shady Tree, been hiding out behind the tree, not talking. Let's see what CLH is. Clean Harbors. All right, they're moving up. Looks like they didn't get beat up today with everything falling apart. I don't even know if I really know what these guys do, to be quite honest, but let's look at the options Montage. So they don't have a ton of different options in there. It's a $60 stock, and the bid ask is 40 cents wide. 25 cents there, 20 cents there. You know, Shady, I probably wouldn't be trading this 30 unless you've seen these be inside of 10 cents wide for the most part. I guess I could look at the 40 days. Those are 15 cents, so that's pretty close, 20. Let's look at the volume and open interest. See, the volume and open interest is pretty low in there. So I might pass this one up. Yes, Wynn got beat up today right after I put on a risk reversal in there. Why is that even up? So there's my risk reversal getting tested. So my idea on the risk reversal yesterday was, yeah, I might want to come down and cover this gap, but I'm safe there. And it did come down and cover that gap. So I'm kind of feeling all right. It's settled down. That's going to act as support. Probably could be a very good time to put on something. All of the, what is it? Is it Macau? The new Vegas over in the Asian region is doing really well, and that's kind of what this gap up was about. Nobody's said anything about real earnings and stuff like that, but all the whispers out of there is that they are stealing massive amounts of market share away from Vegas, because we used to have a lot of that Asian community fly into Vegas to gamble, and now they're just like, why do I need to fly halfway around the world when I can just fly down to the islands here? So they are stealing a lot of market share. So that's why I decided to go long Wynn. So I can't disagree with that. Fortunately, I went with a shorter term. I thought we'd get a bigger move right away. When I started hearing those whispers, I thought we might hear a little bit more, so I went a little closer. So for this, let's look at it a little further away. So as you can see, this is as much better participation in there. It should be, remember what I said, over $100 stock, so let's move it 3 ticks to the left. It should be about 13 cents wide. These markets are pretty wide after today. But if you look at down here, yeah, it got a little wide. Usually Win has tighter markets. So with that being said, I mean, everything's probably going to have wider markets. So I got trapped in the bull call. Yeah, well, at least it was a defined risk strategy, right? Volatility didn't even pump up. So, I mean, I actually was looking at this because I think it's a good trade to the upside. I don't know why Win got beat up and was thinking about actually doing this for this. So let's just look at it anyway. I don't know why the spreads are so wide in here, but we'll go with it. So let's look at the delta and the gamma in here, because I have a feeling we're going to have. So high deltas, I don't really want to go to the 40s necessarily right away. So let's look at the 30s here. So we're going to buy these and then look for like the 16 delta in here to sell those. All right, so that means my probability of being tested on these is 32% chance of the market coming up and testing those 55s in the next 100 days. And the 55 seems like a long way away, but at the end of the day, people are pricing Win a lot higher right now. So, so the 40 to 50, and it doesn't even have to necessarily get all the way up there. If it gets up to 40, let's say 40, 45 even, if we get up to actually 40, 45, if it gets up there to that area, this spread's going to be worth a lot of money already. So rule of thumb, let's look at the 30, see if we can get this to pay for it. We're doing $15 wides, so 20s. Oh, I bought that. I didn't mean to buy that. So we're going to be looking at the 20s and then the 05s to buy to define that risk there. So we're going to be getting an 8-cent credit on it. And that's pretty wide market, but like I said, you guys are wide wings on that. But like I said, if it gets up there, it's going to be making money. So we can look at it a little bit tighter too, and just do the $5 wide ones. And then for the 20s, it's probably going to be, yeah, I'll be able to do this one. So on the 20s, I want to sell those and then buy these. And then 3-cent credit. So like I said, with this strategy, we're not going to be getting those fat like 30-cent, 40-cent credits because we're doing spreads and they're relatively tight. But that's about what you're looking for, is some kind of credit like that. And if it gives you like a 3-cent debit, then I would just move it to 0 and let it work. You don't get hit, don't chase it. That makes sense for you guys? So that's how I would set up Win. And of course, because it sets it up as a combo, I got to go all the way down to 0 or down a bunch of these so I can put it on the risk analyze tab. Oh, what am I doing? What's going on? There we go. So analyze the trade. So it's going to throw in that other spread that I have that's not looking good right now. So there's your analyze tab for this. Basically looking kind of like the other one. And, you know, $500 for every one lot you do. All right. So that's that one. What is, who else had one? I thought I saw a couple other ones popping up. So here, I'll go into, for sake of time, I'm going to go into Kellogg, because like I said, if we're going to be moving out, if we're going to see a sector rotation going on, this might be a perfect opportunity to do something like Kellogg. And as you can see, Kellogg has not participated in any kind of rally. They've been beating on earnings. You know, they beat there, they jumped, but then they just got beat up again. So they've been doing well. They beat again there. They jumped up and then they get beat up, because basically what's happening is everybody's pulling their money out of these somewhat boring stocks where they just trudge along and always make money and want to go for the techs that never make money, but they're more exciting. That's kind of a joke, but like NVIDIA got crushed today, even though the gaming sector is going through the roof. I mean, basically anything tech got destroyed. Anyway, excuse me. So we're going to be looking at Kellogg. So what can we do in Kellogg? We can look at this. We'll look at a couple options like the SEP and the Ds. Go a little further out and see what happens. See how that all sets up. But as you can see, Kellogg's even 15 cents wide now. Kellogg's usually inside of 10 cents. I think we got a little bit of market scare today, and and it's a Friday. Nobody wants to leave their orders in over the weekend. So so we'll look at something like the high 30 delta. It's trading 72.5-ish. So I'm going to look to buy this strike here. So we'll buy the 75s, and I usually like to skip over the half strike ones. So we're looking to collect at least $1.15-ish, right? So then on the downside, we're going to be looking at something like the 70.65, it looks like, to get that $1.15, right? So then I'm going to be selling these here and then buying those. So there you go. It's like the perfect zero for no cash. So basically you pay nothing for this strategy. Your break-evens on the, you have all the way down to the 70 puts before you start losing money at the end when it expires. It's going to look like you're losing money as it goes along and gets closer and closer, and these start getting bigger, but it's not going to be that much. And as you can see, we have $2.50 to the downside and about $2.40 to the upside. So that's why we're more bullish here with this strategy. Remember, on the other ones, we were like going out here and buying like these outright and then selling these to finance it. So you got to go a little bit closer on the puts and the calls, which kind of forces you to be a little bit more bullish, right? So that one would set up. And then we can also look at doing it in the further out. So let's just look at the same strikes for sake of comparing apples to apples, right? So we're going to be buying the 75, selling the 80s, and then, and if you guys aren't familiar with how I'm doing this, basically you hold down the control button and click on them to get it to add it in. And then we're going to be selling this put spread to finance it, and see there for the same strikes we're getting a 10-cent credit. We haven't done anything different, right? I don't plan on holding it any longer necessarily, and we're still got that same directional assumption. So that's why it is better off to go further away. And if I go in tighter like this, this is probably going to be a debit if I do the 75. So if I buy these 75s, sell the 80s, sell the 70s, and buy the 65s, see, then we do it as a debit. And that means we got a long way to go before we start making, we got more of an uphill slog, if you will. And, I'm probably not going to hold this strategy for longer than 42 days. But if I can get a credit for it, I'm more than happy to go out there. As you can see, these markets are 10 cents wide. And usually these are too. So I don't know why they're a little bit wider, but they are. Just the way the market ended today and it being a Friday. But that's why we want to go further out in time with this too. If we can get a fill. That's right, Andreas, it's true. But you'll see with like volume and open interest, these will have quite a bit of volume. Not so much today, but, and you're right, that's if you can get a fill. And don't chase it. Don't go for a debit just to get filled. Just put it in there and let it work, and it might take a couple of days to do it. But sooner or later, it'll get filled. But Kraft, yeah, being that far out, if you looked at Apple or something like that, you'd be able to see Apple has a lot of stuff out there. So you can see there's a lot of open interest in Apple. This is the open interest. That means contracts that are in people's portfolios, basically. So, and then that kind of volume today. All right, so let's look at one more example real quick. What was I going to look at? Coke. See, Coke's going to have that kind of good open interest, even out here 100 days away. And Coke 4 cents wide, despite, you know, but they weren't in that kind of tech stuff, so they weren't having to deal with it. But we can go in and look at the delta and the gamma. So high 30-ish, it's trading 45, 30. 30-ish delta. This is probably the one I'm going to look to buy. And then I'm going to go out a couple of dollars just because, you know, they're one tick wide. So I'm probably going to be looking at something like $3 wide or something. 46, 49, let's just do $3 wide, see how it looks. 46, so then I'm going to have to probably look at the 44s, it looks like, just doing the math in my head. 44s and then buying the 41s. Did I do that right? Oh, what happened? 46s, I said I was going to buy these, sell the 49s, and then buy the, sell to finance it. I'm going to need to get 60 cents, so that looks like I'm going to be able to get 60 cents pretty close anyway. 1 cent debit, so I'd go, not make it worse, but I'd start working at zero and just kind of let the market, you know, when the market's moving back and forth, I could end up getting hit on that and lock it out. It appears that most of your strategies depend on a percent correction. Do you use IV to determine that which strategy to use? Is that almost correct? Yes, Trevor, when I'm doing something where it's a low probability, I'm looking for more of a contrarian play. But I do look for bigger moves, and I'm a contrarian by heart. So I don't always want to like push that because that doesn't fit everybody's book. That's kind of the way I trade. But that's usually where I'm going to kind of start setting it up. A 10% correction, usually you'll get some kind of bounce. You know, unless there's really bad news out there, like, you know, IBM, you know, I've been chasing IBM for the upside for a while there, but I finally pulled the plug and went short on it. But anyway, I do look for that correction to happen. So I do look for a lot of, I look at that more so than like Fibonacci and stuff like that, but I will look at Fibonacci for support, things of that nature. And, you know, this isn't a 10% correction, but Coca-Cola just took a big dip off of nothing, you know, and, you know, it did have a nice run up, and it could come back down a little bit, but I've given myself a little bit of wiggle room. And, you know, it's building value here. It's gaining acceptance and value up at these levels. I don't really expect it to come down here, but it could, I suppose. But it's been trending nicely up. So, and with today's market action, you know, it could be the flight to quality in a sense. And we'll be able to see on Monday if it gets confirmed in that regard. But to also answer your question, my strategy ultimately depends on what implied volatility percent is. And implied volatility percent for some of you newer people, as you can see, Coca-Cola is 0 IV percent. And the reason why is because it is at the lowest level it has been in the past 52 weeks or 200, what is it, 252 days? Is that how many trading days in the year? So that's what it's been over the last year for the most part. And the way to come up with IV percent, just to get a better example, let's just look at Starbucks because it's not 0. The way to figure out your IV percent, which means where it is trading now in relation to where it's traded on itself the past year, is take in the numerator and then denominator. In the numerator, which is on top, you take where it is now and subtract it from the low. So basically you're looking at 15 subtracted by 12. So you got 3 in the numerator, and then divide that by the high, which is 33, minus the low, the sum of 33 minus 12, so 21. So then you divide those by each other, and it should come up to somewhere close to 15%. Thank you, Trevor. Can't wait for the next one. Appreciate that. So in that, I would never be selling premium against Starbucks, other than with a strategy that's going to counteract, volatility like this one. So this one doesn't really matter, because as volatility, if volatility were to increase, it's going to increase my calls, my calls, which is good, right? Because you're long a call spread, you want volatility to expand. But it's going to be offset by those puts, because those puts can expand also, right? And one might say that puts expand a little bit more, but they're relatively going to offset each other. And vice versa, if Starbucks volatility went down, I would lose money on my call spread, but I would gain money on my put spread, offsetting one another. So that's why this one is what I look for, middle of the road, meaning right around that 30-ish delta, because I know volatility is not going to hurt me, and it's really hard to discern which way volatility is going to go for these underlying. Usually when volatility is up here in the 80s, 90s, 100s, that means it's kind of overdone to the upside, just kind of like what I talk about with the market profile. It can't stay up there forever. I mean, it can. Shouldn't say that. It can continue to go higher, even if it's 100%. It can continue to go to 100% because it's at the highest. Just like when it's at 0, it can continue to go down to 0, which is a little bit odd with the way that this is. But the probability is, if it's at 0, it is going to go back up, right? And when it's at 100%, the probability is it's going to go down and revert back to the mean, or where the middle is. Does that make sense for everybody? So that's why I play the probabilities that way, with discerning if I'm buying a strategy or selling a strategy high. This one is good for right in the middle, because volatility doesn't hurt you if it decreases or increases, for that matter. And not to say that you can't do it when it has super high implied volatility. I just would prefer to do a higher probability strategy around high implied volatility, which would be selling call spreads just outright, or selling put spreads outright. That's when I'm going to do that, because I'm going to take that. That's the highest probability strategy you can get, or those selling strategies. So I'm going to take advantage of that. When it's super low, I feel like if volatility increases, I can be directionally wrong and still not lose money that way. So if volatility expands or explodes on me, I can make money even if it's going straight sideways. So, but with this one, this is, kind of neutral. I don't know where volatility is going to go, but I'm bullish. So if I'm bullish and volatility goes down, it's not going to hurt me. Does that make sense? Anybody have any last second questions or anything before I move on? All right, so basically, Trevor, I hope I answered your question right. I play volatility. First thing I look at to determine what strategy I'm going to use is implied volatility %. The next thing I do is, what is the highest probability trade I can put on given the environment that we're in? The highest probability trade that we can put on given this kind of environment is going to be this strategy, because this is kind of that middle of the road where it's like volatility could go up or it could go down. It's kind of like that in-between area. It's the tweener. So this is a good strategy to put on that. You know, when you're way down here in the low IV percent, I'd be putting on debit spreads, because the probability is volatility is going to expand. It's a lower probability trade, but I have the, you know, counteraction of the promise of higher volatility coming forward. Vice versa here, probability is super high, high probability trade, super high volatility gets me further away from where the underlying is. And volatility is usually overstated, especially when you get the high volatility, and that means when it comes and collapses on you, you can make your money really fast without even having the strategy on very long. Do you use strategies with legs with different expirations like calendars? Yeah, Andreas, I do. And as a matter of fact, we're going to be starting to get into those, because we're going to be doing earnings setups, and those are great for earnings setups, and I'll show you why in those webinars. Yeah, so that's a total, you're totally playing implied volatility, especially when you set it up around the earnings, for sure. Great call, Andreas. But yeah, we're going to be doing those pretty shortly. So I hope I explained that clear, because, you know, don't you think you'd be better off playing higher probability trades? I mean, that's what this is all about. Playing the probabilities and knowing when you can get those probabilities in your favor. So, you know, at the end of the day, you guys should be trading with this knowledge, and that's what this course is going to teach you. That's what I teach you in my premium membership, you guys. And this gets you basically everything for $7. So trading with high probabilities leads to higher success, and the best way to become a better trader is to constantly learn, you guys. And for doing this webinar, you guys are already clearly making the decision to do that, because you're basically attending this webinar. Anyway, wouldn't you say that creating or just knowing option strategies or trading technicals is not enough to create consistent winners? I mean, at the end of the day, we're still playing probabilities, and even if you're trading technicals, you are increasing your probabilities a little bit. And just because you know a strategy, I mean, just because you know a call spread is a call spread, doesn't necessarily create winners, right? What I mean is basically, you know, trading the technicals, building strategies to trade the probabilities and become more mechanical is the way to get ahead in this game. And that's what I teach in this course. So how to play the probabilities, when the probabilities are going against us, how do we stay mechanical and increase the probabilities in our favor, and which basically creates alpha. And if you guys have been watching the daily market commentaries, you guys have been watching this whole Pandora. Is anybody watching them on here that have been watching the daily market commentaries with my Pandora debacle? Basically, thought Pandora came down to a nice support level, had high implied volatility, nothing around earnings to be seen, sold 9 puts in Pandora just to collect a premium. I collected, I think, like 53 cents or something for it. Well, of course, it dropped again. So as it dropped, about within like 3 days, I was looking at getting my 9 puts tested. You know, the probabilities are beating me. So volatility hadn't really come off very much. So I sold the 11 calls against it. If you watch Pandora, it went basically down. So, and I collected another 30 some cents for it. I think it was like 88-cent total credit or something for it. And then boom, it dropped down. I think the low was like $8.14. So right there at my break even. Now what do? Well, I rolled those 11 calls down to the 9s and created from a strangle to a straddle. That gave me another 25 cents. If I would have done it the day before, I would have gotten 40 cents. It would have been a really nice trade, but I waited an extra day just to see. And collected another 25 cents today, you know, 7 days left in this option, or 8 days left in the option. Came back up. As soon as it got to $9, pulled the ripcord on it, got out for a 50-cent winner. So, you know, that's what I teach in all of these, especially the daily market commentaries. So like these daily market commentaries, I go trade by trade. In every single trade I do, I talk about the winners, I talk about the losers, and I talk about the losers more than the winners, you guys, because those are the ones you have to stay mechanical, and I teach you how to do that. And I talk about the probabilities in all of these. So for $7, if you were in that same type of trade, Pandora was a loser as of today. If you just sold those 9 puts and let it ride, you're still sweating it out. And instead, I stayed mechanical and was able to get out of it. So, I mean, that one trade alone would be well worth the $7 just to get the daily market commentaries. But on top of that, you're getting 50 videos. Oh, by the way, this is in the chat window on the side, the link for this. So you can either pause it and write it down, or you can pause it, write it down. It's right up here at the top, Premium Wolfman $7 special. But you also get 50 videos, trading workshop archives. Those are the archives of all the webinars I've done. You also get priority access to the live trading webinars, which is, you know, basically full today. It is, I think, full today. So you'll be able to get access to that. You won't get bumped out. And you get access to me, you guys. So if you have a strategy on that is going against you, you can reach out to me. I have a no inbox policy. So if you reach out to me, I will respond immediately, if not sooner. And if I can't answer you in an email, I'll give you a call. We'll talk it through on the phone, because I don't want you guys to misunderstand me in an email. And plus, I hate writing page-long emails, so I'd rather call. So you can call us at 310-598-6677, or you can email us at trading@protraderstrategies.com. Much easier to go in there and click on that link. So if you learned anything at all from me today, you know that you should be trading with this knowledge, guys. I'm just telling you. So what do you say? Go ahead and click on that link, and I'll get you set up straight away. All right? If you can't take that, take it easy. Have a good weekend, Andreas. Take care. Hey, Chris. Thanks, Stan. Oh,